Let's talk about mutual funds. I know it sounds like a dry topic, but stick with me for a moment because understanding these can seriously change your financial game. When you're diving into the world of investments, choosing the right mutual fund company is like picking the right partner for a dance. You want someone who knows the steps, can lead you gracefully, and won't step on your toes. Figuratively speaking, of course. First up, Vanguard. Now, if you've heard about mutual funds, you've probably heard of Vanguard. They're the rock stars of low-cost index funds. Seriously, they have some of the lowest expense ratios out there, which means more of your money stays invested instead of disappearing into fees. And let's be real, who doesn't want that? Their diversified mutual funds cover a wide range of options, making it easier for you to find something that aligns with your investment goals. Then there's Fidelity Investments. They've got a fantastic lineup, especially if you're looking at large growth funds. Take the Fidelity 500 Index, for instance. This fund has a reputation for strong performance, and its expense ratios are competitive. It's like that reliable friend who always shows up when you need them, right? You can trust that your investment is in good hands. Now, let's not forget about Rowe Price. They're known for actively managed funds, which means they have a team of experts making decisions about where to invest your money. They focus on growth and value while keeping expense ratios reasonable. It's like having a personal trainer for your investments, guiding you through the process and helping you build a robust portfolio. And what about Charles Schwab? Their mutual funds, like the Schwab Total Stock Market Index, are another great option. They're all about low expenses and broad market exposure. Think of them as the buffet of mutual funds. You get a little bit of everything without breaking the bank. Now, if you're looking for something with a bit more history, American funds might catch your eye. They've been around for a while and have a solid performance track record. Sure, their expense ratios might be a tad higher compared to the index fund providers, but sometimes you pay a little extra for that experience and reliability. It's like choosing a seasoned chef over a fast food joint. Dimensional Fund Advisors, or DFA, is another interesting player. They take academic research and apply it to their investment strategies. Their approach to diversification and competitive expense ratios makes them a compelling choice for those who appreciate a more analytical perspective. It's like having a PhD in investing, smart, strategic, and data-driven. Then we have BlackRock, one of the biggest names in asset management. Their iShares series is well known for its diversification and moderate expense ratios. It's like having a Swiss Army knife for your investments, versatile and dependable. J.P. Morgan Asset Management offers a range of mutual funds with a focus on active management and diversification. The expense ratios can vary, so it's essential to do your homework, but they're definitely worth considering. Franklin Templeton, with its global exposure and focus on active management, brings another layer of diversity to the table. And if you're into specialized sector funds, Invesco has got you covered. They offer a broad spectrum of mutual funds with varying expense ratios and strategies. So, when you're selecting a mutual fund company, remember to reflect on your individual investment goals, risk tolerance, and how long you plan to stay in the game. Take the time to review each company's offerings, performance history, expense ratios, and portfolio compositions. It's all about finding that perfect fit for your financial objectives. After all, investing is a journey, and you want the best partner by your side.